This is Precision Markets Coach Brian coming to give you a introduction to how to do market entries. So what's important to know is that we got to have some type of trading plan when it comes in for exactly market entries and know exactly when to pull the trigger. So I'm just going to start, as I do every video, we're going to start with focusing on what is the theory behind it, and then we'll get into some actual practical examples of what to do. So when thinking about entries, we're just going to say, for instance, our entry time frame. Let's say, for instance, actually, let me do this a little bit differently. Price comes down, we get a chalk like this, and then price comes back in to enter. And then we expect price to go up. So the key things is we know we've had our chalk, which is like right here. And then we also have, a break. Well, it swept the lows, swept the highs, and price comes back. We identify that we have a demand zone that caused the break for the last supply that was like right here. So we know that this is our demand where we want to enter. So I'm just going to change this to demand really quick. Demand, and then this bad boy over here is a supply. Let me get rid of the extension. All right, so supply was broken, demand caused that break. We know that price is going to enter. Now, most commonly, we can do limit orders, right? So we have limits. We just set the entry at the edge of the zone, and then set the stop loss behind the zone and cover the spread as well. And that's just how we do limit orders. So limit orders pretty simple, right? So what your entry will look like is something like this. So you have to take profit, you do whatever you're gonna do, 1 to 5, whatnot. And then let's say this is where you start, you add a little more to cover spread, you enter, and then your expectation is price will come into the zone, price will go up like this, and then go. So limit orders are pretty simple for you to pull off. But let's go and look at this a little bit differently if we were, for instance, to use a different type of orders. So when you have market entry, you need a couple of things to satisfy your requirements. 1, price has to come into your zone. 2, you have to have some type of trigger to know when to pull the button. So it doesn't exactly change. You don't exactly have to do, for instance, change anything, because you could have, for instance, some type of thing that comes in right here and price does something like this, and then all of a sudden you get your entry trigger, and then price ends up going off, doing something like this and goes on to your intended direction. So it could not change, for instance, anything about how you've entered and changed stop. You can still have the exact same stop as a limit. But also the other downside to using a market execution is that you could have, I'm gonna use this again, you could have price do something like this, and you finally get, for instance, your entry over here, and then what ends up happening is you end up having to make a little bit bigger stop because your entry goes like this. It takes you in the drawdown, then price goes up. And you'll notice that I've also increased my stop loss size, so that decreased my risk to reward. So there's a couple things you have to consider is by considerations, by using a trigger, it could cause you to have a bigger stop loss. 2, or you could have a tighter stop loss than a limit order. And then thirdly, you need to figure out what is the trigger you need to see. So these are all just different considerations that you have. So it could be that your entry trigger comes down here and it ends up being this candle, and now we've just shortened our stop loss and price continues to go off. But that's the biggest difference that you have to look at when it comes to your considerations for market executions. So let's talk about the types of triggers. So you can have candlesticks, or reversal candlesticks specifically, candlesticks to be an entry trigger. You can use things like RSI divergence for an entry trigger. You can use candlestick patterns for an entry trigger. I don't know why I put that. So we're talking all entry triggers. So there's a couple different ways that we could look at this, right? So let's talk about reversal candlesticks. Patterns. I'm gonna actually stop and take patterns. For instance, some people look at a pattern such as, this, like here's a double top, or double bottom right here. And so this might end up being the pattern that you're looking for. And so you say, okay, as soon as I see a double bottom, I'm entering in. And that's how a lot of retail traders trade, is they trade based upon that pattern. So when they see that, they enter. For some people, it could be the breakout of a pattern. So they see double bottom, they see a breakout because price broke through right here. And then price comes back to break with what we refer to as what other people refer to as a breakout ends up being for us just a mini chalk within a chalk. So that ends up being a pseudo chalk for us. And then we enter right here when we get this. And then you see that gave me a pretty standard risk reward, like 5.58 to 1. So you could even have, for instance, divergence. So for instance, if people look and you see divergence and say, for instance, right here, you got this going like this, but you have RSI going like this, you say that's divergence. And so you look for you potentially to enter maybe upon right here. And now I've got a 1 to 6.8 risk to reward a trade with an even tighter stop. Or you just look at it in the last piece, the very first one I mentioned, is just candlestick. So if I see a certain candlestick pattern, like for instance, maybe on this leg right here, I see the candlestick reversal, like an engulfing candle, I enter the trade here. So the key really for market execution is you got to determine what's going to be your reversal candlestick pattern or your divergence or your candlestick pattern you use specifically for entering trades. And so there's all kinds of ways that you can look at patterns to do so. So hopefully this covers the theory part of everything that we want to teach today when it comes to entries. And so now that we've covered the theory, I'm gonna remove these drawings, and we're gonna go right back into looking at what does price do. So I've already picked out a couple of spots, or at least I thought I did. Yeah, I've already picked up a couple of spots where we're going to look at a couple of trade ideas and see how they worked. Give me 1 second, guys. There we go. Okay, there they go. Just took a while from the load. All right, so we're going to pick up a couple of spots. We're going to take a look at NASDAQ. It's one of my favorite pairs. And we're just going to look at entries and different ways you could do entries on different ones using market execution. So the first one we're going to look at is right here. And so let me go down to the 1 minute. That would be a suitable entry time frame. And let's look at all the different confluences that we have. So I've already labeled the point of interest on the 15 minutes. And we're not going to get into this video about points of interest. We're not going to get into it about the structure and direction. We're merely looking at just entries in various spots and looking at ways you could use market execution for entry. So let's go. All right. So I'm just going to put down our list of various entry triggers. And so we have candlesticks, reversal candlestick. We have divergence, RSI divergence. And we also have candlestick patterns. And I'll explain the difference between both of those in a sec. So remember, these are the three that we can really look at. And I'm gonna turn on a couple of indicators. All right. So we have precision entry showing us in this red line at the top. For me, it's divergence. So literally after that divergence, you'll notice that we get an engulfing candle that engulfs the last candle. So let's say, for instance, this is our entry zone. If we use number two, so let's talk about currently using number two. Currently using entry trigger type number 2. That way you know which one's which. So currently we're going to use entry trigger number 2. We have, like I mentioned already, we have the divergence from this point to this point. We have our dot that shows our test, and then this would be our entry. And so then price comes in, and we take our 1 to 5 stop, and our stop loss covers whatever. So depending on how you cover it, I'm not going to get into covering stops, but here is the highest of the candle. Here's some consideration for spread. This would have gone on easily for a 1 to almost 10 risk to reward, if not more. So that's using currently entry type number 2. Then you could have entry type number 1. Let's go to candlestick specifically. So let's say, for instance, one of the requirements that we need is a chalk, right? So price ends up breaking a chalk right here, which gives us an entry zone, meaning that this was a supply zone. And so, for instance, you could have a rule that says, I'm only entering when I see engulfing candles. So you have this small doji, you have this small candle, and then you have this large engulfing candle. And so then you put your entry like this. And so this would be an example of using entry type number 1. And so I'm not going to get into stops, but you cover some type of spread, you let your trade go, and then boom, this is easily a 1 to 5 risk reward. It could have gone much more. All right. Now, this would be an example of using entry type number 1. Let's go to entry type number 3. So another way that you could have looked to enter a trade here is, for instance, we have here one top and then a second top. Or if some people look at this and they say, okay, this is the first shoulder, this is the head, this is the second shoulder. And so what people will do is they combine a little bit of number 3 with number 1 and say, as soon as I see this engulfing candle, I put my entry in here, and then boom, you could cover this high or you decide to cover that high, a little bit of spread, and then bam, price ends up giving me a 1 to 6 risk to reward. So basically what you're seeing is there are all kinds of different ways that you can look at the patterns and be able to see, okay, this is an entry. But number 3 really combines number 1, and sometimes it also combines, number 3 combines definitely number 1, but it also sometimes can combine number 2 as well. So that's just something to keep in mind. But this would be an example of using all 3 different ways of entering as well. So let me copy this, and actually let me save this. All right, and I'm gonna copy this, and now we're gonna go look at another spot. So here we go. This would be, actually, you know what? I'm just gonna move this. So we're gonna move this over here. We're gonna look at this right here. All right. All right. So here we have yet another spot. So here's the demand zone specifically. And so I'm going to start with number 2, which is looking at divergence. And so instantly here we have divergence here. And then we have an inside or Maribozo candle right here. So after this, or even after this one, because you have a second one there, even third candle, because you could have what's called 3 soldiers. You could put your stop, cover some spread, put your entry in, and this would be an example of using entry type number 2. And you see here, this would have been like at least a 1 to 7 risk to reward trade. And these are all from 1 minute entries. So we have the divergence show up using our precision entry as well. And it shows up, we have a candlestick, a strong candlestick, and we enter. So it's using number 2 or a little bit of a combination of number 3 as well. Let's go specifically now to number 3. So let's say, for instance, we have to look for a chalk. So we swept the lows here, and we're going to sweep the highs here. And so we're going to put like our entry zone. And let's say, for instance, I combine this whole little range. And so, okay, price taps into this zone right here. We get an engulfing candle, and let's say engulfing candle ends up being the trigger. as soon as I see the engulfing candle, that's when I enter. So then we cover a little bit more of the stop, and then boom, here we have like a 1 to 5, 1 to 6 risk to reward trade. And so this would be an example of just using, I'm sorry, I said number 3, but I meant to say this is number 1. This would be an example of just using reversal candlesticks. So reversal candlesticks is this bearish candle combined with our bullish engulfing candle. So I'll zoom in a little bit so you can see the two. And that ends up being our entry trigger. So now we can go to type 3, and it's going to be pretty much about the same. So here, a lot of people might look at it and say, okay, they might say that this is a triple bottom. So price comes down, makes one shoulder, makes a head, comes back, makes a second shoulder, and they would have entered in right after that second, right after this engulfing candle, which ultimately would have given us the exact same entry, unless you want to cover more of a stop. So cover more down here and maybe have your entry like this. And so we give you pretty much roughly the same. But as you're seeing, that's the same way of doing it over and over again. It's just using some type of trigger. When you see what you're looking for, then you just press the button without hesitation. And the good thing is sometimes limit orders will go right through your trades. So it helps you to avoid some limit losses. But for the most part, for the market entry, you have to be intently focused, because I know I'm having to pay attention to what I see on the charts. So you have to really look at it, and you end up having to kind of really check and see what you see in there, more importantly. So that's just something to keep in mind whenever you're using market entries. So let's look at one more example, and there we go. So I'm gonna move this bad boy over here, and I'm gonna move this over here. All right. So price comes into our zone, and let's say for instance, price comes into our zone, and we're going to look at a couple of things here. We'll start with reversal candlesticks. So price comes into our zone. We're going to look for our chalk. And so, second guys, let me make my chart a little bit bigger for me. All right. Price ends up sweeping here. Price ends up sweeping here. And let's say, for instance, we get a wick chalk. Price comes in here. We get our reversal candlestick, which we get a inside Maribozzle candle. So then we put our stop something like this. Price goes, and price takes off for us, and then boom, you could have held this trade all the way to a 1-24. So that's looking at it using reversal candlesticks, which would be kind of our first type of entry trigger. Now let's look at it in the second way. All right, so we're gonna look now. I don't know why that thing keeps disappearing on me. There you go. Stay. Move this bad boy here. Okay, there we go. Now we can see more of the chart. Perfect. All right. So now let's look at it using entry trigger type number 2. All right, so we have divergence here, and then price goes and breaks. And then let's say, for instance, your entry would be after divergence, you have to see an engulfing some type of candle. So you could place your entry right here, seeing that you had an inside candle like that matched it, and then this candle goes and breaks it. And so then you put your stop here, do something like this. And like I mentioned, it held for a long time. So let's say, for instance, you held all the way up, and then boom, you're already doing like 1 to 10. Here, it can do a lot more, but you know, it goes on for a long period of time. So that's 1 to 14. So that would be another example of an entry trigger. And it's just by combining the fact that we had divergence shown here. Oh, I'm sorry, that's not even divergence. I forget. You can get confused sometimes by seeing so many lines on the chart. But let's say, for instance, did we get divergence? So we didn't get divergence on this one, but I'm trying to see if we got it somewhere else. Sometimes you'll see it on precision entry early, sometimes you won't. So this type you wouldn't have got it at this point, but for instance, it did tap in over here. So we did get divergence, and you'll notice that we did get an engulfing candle. So a little bit of a combination of number 2 and number 1, but after divergence, you use some type of candle for entry. And so you put your stop here, you put your entry there, and that will at least got you at least like a 1 to 4 risk reward right here. And it's all just using divergence. So the thing is, sometimes you may not see, for instance, in a certain zone, when price takes off, you may not see your entry. And that's just one of the things you have to watch with the market entry. And so you would just miss it. The next place we would see some type of divergence wouldn't be until here. And so the second place you could have taken your order, if you were doing number 2, would have been right here. So we see hidden divergence, price continues on. You want to cover this low, and price ultimately would have kept going. Eventually you could have, mastered a huge trade. So this is also still another type of divergence. And, price goes on and on and on. So boom, you could have had easily like a 1 to 20 trade. But now look at where you got in compared to the other examples that I gave. It's not exactly the same spot, but you were able to manage and have a tight stop loss. So that's another way of using what we call entry type number 2, which would be focused on divergence. All right, so lastly, let's talk about number 3. So number 3, there are a couple different spots you could have entered in. So here, we'll treat this like, for instance, really, this will all been one leg, price comes up, it makes a double bottom, and price goes off. And so then I would have entered in, let's say, for instance, right after this inside bar, the second candle. So it's more like the same, I don't know why it's so big. That is a large candle. Okay. It's kind of more like the same thing as the entry with using a one reversal candlestick. But you'll notice that price comes back into our chalk zone. You have your stop right here below the second of the double top. The double bottom, and then price goes on and enters. So you can, and this would have been going on for even more than you could have got a 125 on this trade as well too. So what I'm really getting at in all things of market execution is you have to figure out what's your definite trigger. And when you see it, no matter what happens, you always enter. And so it's usually tied to a candlestick. Because candlesticks end up making a large part of when you decide to enter the market or when you decide to leave the market. So what you have to do is determine what is it that you want to see and what candlestick do you want to see that will help you to do that. Now, there's a whole bunch of ways that you can look at candlesticks. You can use, for instance, dojis, which mean neutral, or you can use things like spinning tops. Or you can use one of these candlestick patterns that already exist. Like, for instance, if you see 3 bearish candles, that usually means strong presence. A lot of people like either the evening doji star or the evening star, so they see bullish coming into it and they see bearish. Or you look at things like bearish engulfing. But there are a lot of different candlesticks that you can use, and that we'll save for another video to talk about the whole anatomy of candlesticks. But this kind of concludes on how you could look at market entries. If you have any questions, feel free to share within the Discord group, and we look forward to seeing you on the right side of the market. Thanks so much for tuning in.